Bring that ass back like a boom, 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 boom.
Hello everyone, this is Supernova and you're with Boom Traders weekly market overview for week number 14, and we are just heading into April. A happy Sunday to all of you, and let me just start our session overview with what you can expect to see in our market weekly overview. So as usual, we have the risk fast, the tactical trading environment. We're also going to take a look at the current markets, and then we're going to do a summary. And the first thing I want to point out is that we did have a buy signal on the 21st of March this year, but we are in an overall negative environment still. Now, last week we had the general market and the up down volume being positive. This week, with the recent events, we have it back on neutral. New highs, new lows, still negative, and stock participation, we have it on neutral. So, in other words, the market is shaky at best, and maximum caution is warranted when you trade breakouts. Our tactical trading environment signal is still on yellow, which means that the market is highly rotational, and you can trade, but you need to exercise caution. So with this, I really went through the market environment very quickly. I want to be a little bit more in depth in looking at the indices and what the underlying market internals are saying to us. So without further ado, let's head on to the indices. Now let's start with the S&P 500, and as you already know, I use a two chart layout. This is the weekly on the left, and this is the daily on the right. Now the first thing that I want to point out, and it's better seen on the weekly, if we zoom out for each of the prior drops, and you can see right here in 2016, well, late 2015, then 2016. Then the other drop in 2018, and then the COVID crash in 2020. Look at the volume, guys, and let me just see. Okay, so look at the volume spikes. These are the volume spikes that supported even this little drop here at the beginning of 2018. But look at the volume spikes. So what we're seeing right here is definitely a lower volume in terms of support of our current lows. And if we go to the daily chart right here, what you will notice is that the first leg down, basically late January, got more support in terms of volume than the later legs down right here. And you can see we're making higher lows right here, whereas volume is depleting. And that's generally a negative sign. Look at the volume that we had on the S&P 500 on this rally. It's going down. Like if you draw a trend line right here through the volume, you will see that basically the volume is going down all the way while we are going up. And this is something that it's definitely a negative sign for the rally. We definitely needed to see more volume, although we had quite a lot of bullish days. These blue bars right here indicate the bullish flow. The volume was definitely lacking. So this most likely it was a bearish rally up, and we'll see how it goes. But what we saw the last couple of days was another break of the uptrend, although we had like almost this is like 10 days of positive action, low volume, and then we were rejected right here at those two highs. If you can see them right here, let me just draw this for you. We had a rejection right here on those two bars. So we did try to break, and we did for a couple of days. Then it was followed by a gap down. As you can see right here, we have this right here. So we had those lonely gap above prior resistance, then a close right on top of it. So at this point, I was actually thinking that we can actually hold this, and maybe if we move above this high right here, we can blast to the upside and test these recent highs here at 475. However, it was followed by a huge day, and you can see right here the volume on this day. It was followed by a huge day, a move to the 200 day, which is the purple line right here, and then a gap under the 200 day. Now what is really important to see right here, if we zoom in a little bit, this one tried to close above it, could not. This one closed above it, but the next day immediately was followed by a gap down and closed right under the 200-day. So definitely bearish looking environment for the S&P 500 and in general for the markets. I will show you in just a second the market internals for the S&P 500 in terms of new highs, new lows, and in terms of advanced decline of the stocks, so you get a better understanding right here. We don't need to go to the market internals for that. Now let's head on to Nasdaq. Nasdaq is actually looking even worse. It couldn't get over 200-day moving average right here, and now it's flirting with the 50-day, but it closed below it. And in Nasdaq we saw better support like volume. If you can see right here, volume was quite elevated for the support. Prior volume bars in 2020 and 2018 were lower in terms of support. However, we noticed the exact same pattern in terms of volume when we made those lows. Like this first low below the 200-day moving average was met with large volume, and then volume actually was depleting all the way. Yes, we were also making lower lows right here, but volume did not really suggest any rally. And again, the volume on the rally itself was low at best. We were able to close single day above the 200-day moving average. We were stopped right here. As you can see, right, this was our resistance. We made a close above the 200-day moving average, but that was quickly rejected. Another try, but look at the volume on this try. That was like the lowest volume that you can see right here, all the way from probably January. If you see, this is January, so it's not the lowest, but it's right there with the very beginning of January. So this is one of the lowest volumes that we had on this rally up to the 200-day, and succeedingly that was rejected as well. Now we are right at the 50-day, and we actually closed just a tick below it. So we'll see what happens on Monday. IWM, which is the Russells did not even get to 200-day moving average right here, although we've had very good looking bottoming action right here with this higher low right here. Again, the rally up was not as furious as it was in the S&P 500 and the Nasdaq, and also was accompanied by the same low amount of volume. So volume is really important when we need to look for rallies. But this one did not even get to the 200-day moving average, now closed below the 50-day moving average, so definitely looking weaker of the three so far. And last but not least, Dow Jones Industrials. It's in the same situation as is the Nasdaq. However, we recorded 4 days of consecutive, 3 days of consecutive bullish action right here of the 50. So that was definitely support. And the other thing that I noticed that we're seeing a little bit of a volume rise right here in Dow Jones Industrials, and that's probably due to some of the stocks right here leading in terms of performance. So this is how it basically looks when we look at the indices from the upside. Now let's just move into the market internals for those 4 indices and see how the new highs, new lows, and the advanced declines are performing. I have this set of charts right here for the advanced decline lines, and the first thing I want to point out is this bar right here is all US stocks that are advancing, and this is the all US stocks that are declining. So this is how the general market picture look like. And if we see and if we point out right here, this is basically the chart of the advanced decline lines for the entire market of all listed stocks. So what is really visible right from the get-go is that we've had only a few crosses of the stocks that are making 52-week lows right here and right here above the stocks that are making 52-week highs. So the green line that you see right here, that's a little bit bold. That's the moving average of the stocks that are making 52-week highs, and it's been on a constant level above the stocks. This is the red bold line above the stocks that are making 52-week lows. So this flipped as you can see, late November of last year, right around here. That date exactly was the 23rd of November. We issued our sell signal on the 22nd of November. So, as you know, the 23rd of November, this flipped. And see where it actually did so. If we notice the previous flips right here in October, look at the level that it did it to. So that was about 216 for the week, for the lows and for the highs, and right here we have it at 479. So this was a very high flip right here. We flipped. We tried again in the very beginning of January of this year, and then this has been the case from the beginning of the year. So we never saw the stocks making 52-week highs exceeding the amount of stocks that are making new lows. Now, one thing you really want to note is even in the rally, when we saw this huge rally in the S&P 500 and the Nasdaq, we did not, we were not able to actually get this to a positive level, and that just speaks enough about the weakness of the market we are in. So now let's look at the S&P 500. On top right here, you can see the chart of the S&P 500. I don't have moving averages, but what you can see right here in this blue line is the advanced decline line. So basically, this is a comparison between the stocks that are advancing minus the stocks that are declining, and it's quite visible right here that this line has been a downtrend. We did try to rally off from the bottom right here, but even if you see, if you're careful enough, let me just show you this. We have slight divergence. So the S&P 500 is making a new high in terms of this rally right here, and the advanced decline line on the second attempt made a new high. Stocks did not participate actually. So this actually shows that there were some stocks that were advancing, some stocks that are declining, but in terms of the S&P, that was not the case. So we saw some divergence right here. And as you can see here, we have the new highs, the new lows. Actually, some more stocks right now in the S&P 500 that are making 52-week highs. However, the index itself is not participating at all. So this is the situation for the S&P 500. Nasdaq, a very dire situation. Advanced decline line is dropping. It's been below zero, so it's on a minus level. More stocks have been declining than stocks have been advancing for quite some time. I think the last time when we're at positive, it was, yes, early of this year. So same situation as you can see right here, red all along. Even when we recorded this rally for the Nasdaq, there were only, I think, a couple of days that we saw the stocks advancing, the stocks that are making 52-week highs exceeding the stocks that are making 52-week lows. So Nasdaq is really weak in this regard. In terms of IWM, same story as I said, and this is something that you really need to pay attention to. So right here we have the advanced decline line making new lows. You see in this channel where IWM was trying to break out of this channel to the upside. So basically the stocks in IWM in terms of their respective movement are not suggesting a move to the upside for the index in general. Same thing here with the stocks making 52-week highs and lows. As you can see, quite a lot of them are making 52-week lows compared to the ones that are making 52-week highs. So really weak situation here as well. And last but not least, Dow Jones Industrial. Let's look at, let me just remove that, I'm sorry. And let's just look at the advanced decline line. It actually has been rather holding. As you can see right here, we are in the very upper portion of the advanced decline line in general for the last, 2017. We are pretty strong on Dow Jones Industrial. And since there are only 30 stocks in the ETF, this is not really telling any story for the stocks that are making 52-week highs and 52-week lows, but the overall strength of the Dow Jones is supported by the advanced decline line. So in very short, this is something that I look for to see how the different markets are reacting. And one thing I want to note as well, when markets start to turn and go bearish, the first one to actually fall are the weakest stocks, and IWM is basically the ETF of the weaker stocks. So really be careful right here. I think that we are in for some more movement to the downside, also suggested by Federal Reserve actions recently. So now let's take a look at other markets like gold, crypto, oil, which is again on a tier, bonds, and then we're going to take a look at the other market internals like the VIX. So now let's look at some other important parts of the market. First, let's start with gold futures. I do apologize for switching between TradeStation and Thinkorswim, but there are some market internals that I find very helpful and that are exclusive for TradeStation. They have it in their ticker symbol library, and Thinkorswim does not. I prefer charting on Thinkorswim, and in terms of indicators and coding, Thinkorswim is my go-to place. So let's do most of the stuff right here on Thinkorswim right now in terms of charting. This is the gold futures. They are setting up for a move again to the all-time highs right here. It looks like a very interesting power play that we can set up from this consolidation area. Now we need to see some more volume. We saw this coming in on Friday, and Thursday we also had some gold names like AEM, SSRM, NEM. They were popping, FMV as well. They were popping to the upside. Some of them we played, and I really think that there is a case for gold going all the way up to the all-time highs, especially considering the fact that there are basically no support or resistance zones on this fast drop right here, which happened in there was like 1, 2, 3, 4, 5 days. And we were back to 1900. So there is no way to form any support or resistance zones right here with this fast drop. So this is a fast zone, and we can move up to the all-time highs pretty easily. Now the other one that I want to take a look at is oil. And as you can see right here, oil made some topping patterns right here with this lonely candle and high volume exhaustion move, and then we tried to rally. We were rejected around 115, and now we're moving back to actually generally normal levels of oil. So I don't really expect for oil to go higher than this, simply because the United States are doing whatever they can actually do possibly to suppress the price of oil by releasing reserve quantities from the United States oil reserve. And although the Saudis are not cooperating in terms of pumping a little bit more oil to keep the price down, I think that that was it for oil. However, there are some other indications for basic materials like coal that are showing some relative strength, and as well European Union will probably sanction Russia and will stop importing coal from Russia and Ukraine. Therefore, some of the coal producers might start popping up again. So that was about oil. Now let's take a look at Bitcoin and Ethereum in crypto space, BTC. As I said, whoa, I've been drawing here. Let me just remove all the lines. As I said, I like the fact that we saw some relative volume coming in from the lows right here, and you can actually draw a channel if you see what I mean. If you start with this high right here and extend it, and this low and extend it, and you can see that there's like a channel with, it's actually tightening up. If this line probably worked, so you can see it's tightening up to the upside, and if we connect those two, you can see it's definitely going straight up. There is no support and resistance. There is some consolidation right here and some consolidation right here, but in general, the good thing is that Bitcoin and Ethereum, for that matter, actually Ethereum looks a little bit better, are are actually holding up pretty well in relation to Nasdaq. And so for now, recently there was an article in Bloomberg that the true value of Ethereum right now should be about $6,000. So they are placing Ethereum on their undervalued assets list, which is a good thing. And that's pretty much it for Bitcoin, Ethereum, crude, and gold. Now let's take a look at the sectors in the S&P 500 because I think there are some conclusions that we can draw from there. Let's quickly go over the put-call ratio. And as I said last time when we spoke about this, I would really like to see put-call ratio hanging around 0.75 and moving in this range between 0.75 and 1. So far this has been the case, so all good here. And in terms of VIX, as you can see right here on top I have the S&P 500 and on the bottom I have the VIX. As you can see, this is a 20-day moving average. S&P 500 is playing with it right here, staying at it. VIX got rejected at the 20-day moving average as well. However, if we are to see a move from S&P 500 to the downside, I expect VIX to go up, and pretty much S&P 500 and VIX have been moving quite the opposite way of each other, and you can see this right here with the Bollinger Bands. So basically a move of VIX above the Bollinger Bands is accompanied by a move of the S&P 500 below the Bollinger Bands, and then an immediate snapback. So this is a good signal to use. Right now we are in the middle of the two, so basically Monday, Tuesday, and next week in general will be decisive week for that. And I'm not gonna bore you with more market internals. I think we did a pretty good job in the major indices overview in the beginning of the video. So that's gonna be it for today in terms of market internals. I have some notes, and then we're going to take a look at the top and bottom industry groups and the sentiment, and as well do a summary just like every week.